The rules changed. Not the rules of the SpaceX IPO, the rules of the major stock indexes in America. FTSE Russell rewrote theirs. Nasdaq rewrote theirs. Both pointed at one company, SpaceX. Then the biggest index of all, the S&P 500, was asked to do the same. It said no. That one decision changes the trade most investors think they understand. And you have until early July, about 3 weeks after SpaceX trades, before the window everyone is watching slam shut. After that, the math flips. Let's step back and look at what that means. Trillions of dollars sit in passive index funds. Many of them must mirror their index exactly. When a stock joins the index, those funds buy it. No analysis, no debate, no discretion, mandatory. So the question was simple. What happens when the largest IPO ever forces its way into major indexes in the first few weeks of trading? Part of that answer just arrived. The biggest source of forced buying, the one everyone was counting on, was taken off the table, and barely anyone has reworked their math. Hey, welcome to New Stock Signals. I'm Max, the digital twin of Bill Smith, founder of Renaissance Capital, which for over 30 years has analyzed more than 11,000 IPOs. Bill personally researches and writes every video script himself. I hope you enjoy. He reads every comment, so be sure to share your thoughts below. Nothing here is personal investment advice. Talk to your own advisor before you act. Here's the reality. SpaceX is not a normal IPO. It's so large that the market had to reorganize around it before it even traded. Index providers rewrote eligibility rules. Passive funds modeled billions in automatic flows. And retail investors are reportedly being handed close to 30% of the offering. This matters to three groups. It matters if you hold index funds because SpaceX exposure is likely coming your way. It matters if you're an active investor. Knowing when the forced buying hits changes your timing. And it matters if you're on the sideline because there's a specific window to understand before you decide. What I'm going to show you is the mechanism behind the flow, not the story, the structure. Let me take you back to December 2020. Tesla enters the S&P 500, market cap around $650 billion, already one of the most debated stocks on the planet. But the debate didn't drive what came next. The day Tesla joined the S&P 500, index funds had to buy a large block of shares, estimated in the tens of billions of dollars. Mandatory, automatic, no choice. The firm Aptus Capital made a related point about SpaceX. For a stock like this, they argue, traditional valuation logic doesn't apply in the early window. Aptus said it plans to build a position in stages, betting passive demand drives the early price. Be clear on what that means. It's about one thing, the forced passive buying window, not the long-term thesis. Here's the structural pattern that matters. When a company is anticipated for index inclusion, prices often run up in the weeks before, peak around the rebalance date, then flatten or pull back after. That pattern repeats, not every time, but often enough to matter. With SpaceX, we have a fast first inclusion, and then a door that just closed. That changes the math. Here's what really matters. At least two major index providers changed the rules to make room for companies like SpaceX. Each operates on a different timeline. Each carries different weight. FTSE Russell, 5 trading days. They adopted one of the fastest timelines in the market. On a June 12th IPO, that points to inclusion in the week right after. It's the first wave of mandatory buying. Nasdaq 100, 15 trading days, down from a roughly 3-month minimum. On a June 12th IPO, that points to a rebalance in early July. From a passive flow standpoint, this is the most important early inclusion. The funds tracking the Nasdaq 100 hold enormous assets. But the S&P 500, that door just closed. This was supposed to be the largest prize of all. Bloomberg Intelligence estimated fast-track S&P inclusion would force roughly $14 billion in passive buying. Then in early June, S&P said no. It refused to waive the profitability rule. It refused to waive the float rule. It refused to waive the 12-month seasoning rule for size alone. So the single biggest source of forced buying is off the table for at least a year. SpaceX must post 4 straight profitable quarters and clear the float test before it qualifies. That's the headline most coverage buried. Now here's the structural tension every investor must understand. SpaceX built a staggered early release schedule into its insider lockup. Insiders can start selling in tranches after the first earnings report, with the rest releasing over 180 days. But Musk himself is locked up for a full year with no early release access. The original story assumed a wall of S&P demand would absorb that supply. That wall just got smaller, while insider supply still releases on schedule. This is the nuance most retail investors will miss. The forced buying narrative lost its biggest pillar, and the supply side didn't change. Let me give you the practical framework. 4 investor types, 4 different approaches. If you hold index funds, you may already have exposure coming. If not, the question is whether to get ahead of inclusion or let it happen passively. If you're an active growth investor, watch the window between IPO pricing and Nasdaq inclusion. That's the stretch from June 12th into early July. This is when passive demand builds while early lockup supply is still limited. Understand the risk. Size accordingly. If you're a fundamentals first investor, the S&P 500 is your key event, but there's no S&P technical floor coming for at least a year. Meanwhile, the staggered lockup keeps releasing insider supply through the back half of the year. For you, that removes a reason to rush and gives you time to judge the business on its numbers. With the S&P catalyst pushed back, your edge is patience. Let the first earnings prints come in before you size a position. If you're risk-focused or ESG-oriented, I want to point out that Denmark's Akademiker pension, which manages about $25 billion, said it won't buy SpaceX. Its CIO called the company grossly overvalued and pointed to what he described as a catastrophic governance structure. Dual-class shares give Musk roughly 85% of the voting power. Public holders get almost no say. This is real big money pushback. Some capital stays on the sideline regardless of index mechanics. Here's the key dates calendar to watch. Now let me address what I know you're thinking. First objection, the valuation is extreme. A $1.75 trillion valuation, more than 90 times trailing sales, many times the broad market multiple. Roger Ibbotson at Yale, who studied IPOs for 50 years, makes the bear case bluntly. He argues much of SpaceX value sits in its story, and that those stories are hard to deliver on. That's a legitimate concern. The valuation requires you to believe in Starlink growth, AI infrastructure revenue, and long-term upside that doesn't yet exist. Be honest with yourself about your confidence level before you size a position. Second objection, the retail allocation changes the calculus. A reported 30% of this deal going to retail, potentially north of $20 billion, is unusual. The traditional playbook has institutions take allocations, then retail bids the stock up after. SpaceX may be inverting that. If retail is filled in the offering itself, the typical post-IPO retail bid may already be spent. That's a real structural question without a clear answer yet. Third, the S&P story already has its answer, and it's not the one most people priced in. There is no fast track for the S&P 500, so the roughly $14 billion in S&P-driven buying that headlines assumed, it isn't coming for at least a year. If you still hear forced buying used as a reason this can only go up, that case just lost its largest piece. Treat the remaining FTSE and Nasdaq flows as real but smaller and time-limited. The bigger picture beyond SpaceX is this. If this listing goes well, expect OpenAI, Anthropic, and other private giants to follow. If it stumbles, it could cool the whole pipeline. The stakes extend well beyond one stock. Let me pull this together. The biggest IPO in history forced the biggest ever rewrite of index rules in the modern market. FTSE Russell bent, Nasdaq bent, the S&P 500 held the line. And that denial matters more than every rule change that passed. The forced buying that remains is real, but it's smaller and packed into the first few weeks. An insider supply keeps releasing on its own schedule. The window that matters most runs from day one of trading into early July. That's when flows beat fundamentals, and early supply is light. Most investors will confuse the excitement of a historic moment with the precision needed to trade it. This isn't about whether SpaceX is the most important company of this generation. It may well be. This is about knowing which force is moving the stock, when, and why. Quick ask before you go. If this was useful, hit subscribe and like. It helps the channel reach more investors who need this kind of breakdown. And if you want the full framework, the one I've used for 35 years across more than 11,000 IPOs at Renaissance Capital, the link in the description has my new book, The New AI Stock Edge: How the Pros Spot Tomorrow's IPO, Leaders Before the Crowd. Every signal I just walked you through, index mechanics, lockup math, the 4-investor framework, it's all in there. Plus the rest of the playbook for the wave of AI IPOs coming behind SpaceX. If SpaceX is the trade that has your attention, OpenAI and Anthropic are next. The book gets you ready before they price. Here's what I keep coming back to. Discipline compounds capital. Hope doesn't. The market doesn't reward the most excited investor. It rewards the most prepared one. See you in the next one.